We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Francis Hunt, the Market Sniper. He's a CMT in technical analysis and the founder of themarketsniper.com. Francis, thanks for joining me today.
Delighted as always to be back with you, Tom.
So, Francis, maybe we can start with, trying to understand what's important to you about this banking crisis that we're seeing. Is the world debt catching up with us now that the interest rates have come off this 40-year trend of complete decline?
It's a great question. Basically, what's the macro backdrop for the events that you're referring to in terms of why they're going down right now? And is this part of a natural contagion that has to happen to get to the collapse, the controlled demolition that we've referred to before? And as you know, Tom, we called the turn in the debt markets on the March 2020 events that will not be named. You had a super capitulation on yields, which is a pump in valuations on debt markets. And we're around about August of that year, we said that was such a capitulation, and the snapback rally that came out of that is the bottom for yields, and you're going to see a tightening of yields. At that point, no one was even thinking about inflation. Everyone was talking Japanification, deflation and all of these things. Then we started to get some inflation. They said it was just passing by, then they went transitory, and then they admitted it's a problem. Then we ended up with a very abrupt. So the Fed was late to respond, and we got the very abrupt steepening curve where you had 4 back-to-back 0.75 hikes. And the lagging effect of that takes a while to kick in because people aren't buying things every day, especially the big assets like homes and cars. But as and when they're forced to, because they're moving for a job or they're doing various things, they're suddenly finding, ouch, that's costing more for refining on that property market. You've had 6 months odd of property market down. Commercial is wrecked, particularly with the work from home trend, the reduced level of workforce. We passed peak boomer into retirement. So there's an absolute scale of long-term demographic oil tanker turning events that are placing great pressure on interest rates. And of course, the super, super low interest rates created such asset price inflation that you have the US as the most probably hypervalued equity market, just as boomers start to divest as a result of their life stage cycle now being retirement. So in that environment, you're going to see a lot of asset price deflation or disinflation. And we've got the hyperstagflation aspect that we refer to, which is stubbornly high inflation. This thing's going to keep coming back at them. They're going to think they've won it, and it keeps coming back at it. As we said before, it's a monster best killed small. They never did it. They waited too late. Now you're wrestling a strapping teenager with lots of energy and verve, and you can throw him to the floor and he's bouncing right back up. And the cure for throwing him to the floor is actually killing growth by increasing rates. So you're going to have stubbornly low growth curves with very, very high inflation. So you've got this X where both are moving in the wrong direction. And I referred to this as the inverse Goldilocks effect, which was the Greenspan era, where with globalization, everything just got relatively cheaper in terms of outsourcing, construction, manufacture, and everything. So input costs stayed low. That allowed them to run interest rates much lower than they should, which allowed asset bubbles to inflate in the first place. So you had this mass affluence feeling where actually your cost of livings were staying relatively low, but asset prices were inflation. That is inflation. You did have inflation, but it was the asset prices. So you had homes and equities. So now we have to reverse all of that. So as you have day, so you have night. As you have yin, so you have yang. All of these principles. So the longest day leads into the longest night. And those contractions are going to be deeply uncomfortable. And what you actually seen recently is that, in actual fact, the dollar in the Sphere event regarding your question on the banking stability has not done exceptionally well as a result of it. It's taken a few points off the euro, which is an equally sick leper in the same leper colony. But the real stories is Bitcoin and gold. the God markets of anti-fiats, the digital version, and more specifically the physical version that is gold held in hand. And gold has been super, super robust. And technically, we suggested that there was that, it may be worth taking in the chart, if I can share the chart with you. Technically, we had the bear flag, a very broad structure that was similar to this. And let's get the chart up image so I'm not painting pictures in the sky there. That we've said is actually a macro continuation structure for the upside, and that the breaking of this red line over here, which you've touched a number of times, so I'll just highlight that as well so that everybody sees that nice and clearly. So we are technical, we understand the fundamentals very, very well, but the manifestation is don't listen to what they say, have a strong arm hold on truth. And truth is what's happening in the markets in terms of the money. And these were what we refer to as a capping descending grind line, where you tapped out on the high side a number of times. And at this last tap out, we said you're going to get a pullback of some variety, but we don't suspect you're going to go and revisit the bottom side this time. We think you'll either bounce on the 1800 or you'll pop down to our splitter level that I've put in dotted gray there. In fact, you found a floor even earlier, and then we've turned. And the crisis almost preempted that relapse phase and seen gold actually break. And more importantly, now on the same calendar, this is a 2-daily chart, so it's not a small time frame here. More importantly, this is the first close that you've had above this red line that I've drawn over here. There's no close. It's a wick run. It's a wick run. It's a wick run, and it's only on a wick run. Now you've had a close, and now you're getting a small bit of pushback. So it's very typical technically when you break a key grind line, which is not a price point, it actually has a gradient to it, that you get a revisit back. And that's probably what's happening today. Don't forget, you've done quite a lot in quite a short time, 1820 to, I think it was 1980, virtually the highs. So a little bit of a visit back. Now you're bouncing on the roof. Instead of being below it and it's a ceiling, now you're revisiting that level. So that's a positive development. Key levels and angle lines fall slowly, and the process is you penetrate them with momentum, you revisit a little bit of exhaustion for jumping the fence, and you pause, hands on knees, and then you regain the momentum, you catch your breath, and you move on up. So it's good progress, this from gold, and it has been dominating silver, and that's okay. I know many guys are also heavy into the silver and see it as the ultimate mover. By choosing silver, we've chosen phase 2 of the big run, because invariably it starts, as we refer to in the God market. So the big money needs to put a lot of fiat into something physical and doesn't need the storage issues that a huge amount of silver provides. You can have $1 million. You might even be knocking close on half a ton of silver for that amount. It takes some storage. It's heavy stuff. So the secondary phase, when we really start ripping, is when silver starts outperforming. So on the gold-silver ratio, we have had a broadening structure. So I'll pass by that chart as well, because it might preempt some of your questions regarding silver and gold as well, and when that turn might be and what would be the technical circumstances. So gold looking good and has now broken a level that it hasn't. Also, by the way, before I leave gold entirely and go to the gold-silver ratio, I want to highlight that we're so trained to think of gold in dollar terms, but gold against most of the major other currencies is very close to making new highs if it hasn't already done so. So we've drawn a rising wedge as our long-term scenario for gold against the euro here, for example. And you've already spiked now recently, and we had this scenario drawn on, I think, even when I last spoke to you. You can see this. So this is squeezing higher with a lot of buying coming along here along the lows. It didn't pull back very far here. A lot of buying coming up along the lows. We suggested here a cluster of levels to be revisited, and then you could go back up to the other side. And that actually has happened. So right this second isn't necessarily the greatest time to chase in, because you probably get a little bit of drift down and you might visit one more time. But I would expect in the longer run for the investors that are less sensitive to that in the moment and the dollar cost averaging guys, carry on, go. But if you're about to put a lump sum, make sure you use limit orders, and you can maybe, if you're in the euro area, you could put a bid in around the 1800. But I mentioned other currencies. If you have a look against the pound, you're at new all-time highs in the pound. So just wipe my face a bit there. You can see you've squeezed through an ascending structure there. So 1575 was a very critical level. It was the high of the post-COVID recovery, all stimulus, all singing, all dancing, which of course masked a bailout to banks, where just a single bank in the name of Nomura got virtually 4 trillion. Many people don't see the events of CV19 as actually being a bank bailout again, because they hid that information. JP Morgan got about 2.8 trillion. I mean, these were all loans. I don't see those loans getting paid back. That is dilution of your currency.
Was that to do with the repo market collapse?
Correct. Repo started to show real weakness pre the events, and I think that brought it a bit forward, if it's down to me and my guesswork. But let's stay out of that rabbit hole. To September, October 2019, it was real beginning of crisis. And when they did that, they released these huge credit line in March, and that coincided with the noise of everything around lockdowns and whatever you believe to be about the merits of the virus. But you can see here, going back to this is a key seminal level visited 4 times, 1575 in GBP for gold. And you've just continued to get bought up. It got steeper here. You broke and you ran through the 1600. And this is minor pullback. It's typical of technical analysis to break a key ceiling level with momentum and then have a little bit of a pullback. So you've got the pound that's recently made new highs. You've got the yen that's recently made new highs in gold. You can see we're expecting further 265,000 targets short and medium term before, of course, going higher. But this is broken out and is making great progress towards that target up top there. So we've had setups across gold on all forms of fiats. And if you're in Australia, this is another major ascending triangle. I'm currently long gold against the Aussie right now because the Australian dollar looked particularly weak. For whatever reason, they're buying submarines for all-out war of some sort. So maybe they're going to militarize and get all cocky with the Chinese as well and vote with the Western axis. I don't think it's the smartest idea that they have, but you can see 2,800. You couldn't hold that level. You couldn't hold that level. You couldn't hold the level. It was resistance. And then you had that steep, again, very characteristic, a lot of commonality in the technicals, obviously, with gold being the common factor, breaking with momentum here. You've smashed the 2,800. We have a target well through 3,500 on this and have had this for a while. So yes, don't go in right now, a bit of exhaustion on the week, a little bit of a red candle. This could come back. But the longer goal is that. How far, whether it revisits the technical level entirely, I can't tell you. But the macro move is in that direction. If you're thinking it and you're an Australian watching this program right now, you want to get out, but maybe pick your time. So again, limit orders are your friend. We do technical analysis on a lower time frame, find smaller structures, and guess where, on an on balance of probability basis, it might find some support if it's above the 2,800 level. And we try break our way into that trade, always with tight stops and very light leverage. And then it's more about letting the move make you wealthy than the size as principle. So people that haven't got experience with leverage should be cautious. And this is just non-advisory. But we've just run the rack on a number of currencies. My own personal place of my birth, the Rand, where the lights are virtually going out in South Africa. This is a gold producing nation, once the highest of all, the home of the Kruger Rand, and their currency is giving up to new highs on gold. So gold is winning. The gold is doing exactly what it should be doing, and it's going to continue to do. And I was dragging you into the question, what about silver? And I was working my way to the gold silver.
Francis, maybe just before we move off of that, could we look at the gold versus Canadian dollar? Because I think that made new highs as well.
100%. It's almost did, Tom. In short, the CAD has just held it off. It almost did. The run, the last bull run that was associated with the events of March 2020, had a slightly higher high, but you're knocking on that door after quite a lengthy period. I could go weekly; it might be easier to spot that. But you can see you've just about made it, not quite, but it's coming. And this is again, you only have to look at the yen, the pound, and the others. The euro is in a similar situation as the CAD. They're both barely hanging on, and gold is coming for that level. It's sniffing it out. So the honey badger's on the prowl, and he's not giving up. He's determined, and gold is it. And the fiats are being shown up to not be nearly as tough as gold, the honey badger. So I'm loving the price action on the metals, and it validates everybody who's been purchasing metals during this period, particularly gold. It runs first. But there will come a point where you will pivot and you'll start to get the overperformance on silver. And there will come a point where the equities, of course, will start to do more. At the moment, gold is actually the main driver. So when you get the God market moving first, the others kind of say, well, let's see, we'll come in behind, let him be the pace car. We'll come in behind. And then when we really see this race is on, we'll floor it and we'll try to zip past him. And in essence, that's what we're witnessing. That still hasn't stopped silver from picking up from an 18, 19 odd low pullback, but it hasn't technically broken its capping red line there that I'm showing you, although it's had a nice little perk me up. So it revisited its neckline. It had a head and shoulder. And I think the last time I spoke to you, I was pointing this out because it's been a while since we were on together. But you had a head and shoulder with a neckline at 20.7. You ran 25, just about 24.76, which was the target. And then you've come back and revisited that neckline. Very typical, standard, but this is largely bullish. This was a secular reversal. 18.5 was rejected after a couple of tests. So silver needs to just stay on gold's shoulder for a while. And then when it breaks there, that could be a real beginning. Lots of stories out of various news sources about COMEX on silver. Some of these are going to turn out to be true. Many people, I don't know if you heard this one, Tom, but it's outrageous of just the level of fraud.
Let me guess. The LME nickel and JP Morgan nickel/rock trade.
Yeah, they were short nickel, long rocks in a bag. I was thinking that's an interesting trade. I would probably take the other side of personally. I mean, this just goes to show the absolute skullduggery and potential fraud. And I'm afraid you're going to see even bigger things that are going to shock people in time to come. There is going to be a pulling back of the curtain here. And that is going to expose all elements of fraud that has been going on. And I mean, when I first saw it, I thought, I can't retweet that. That's such a dodgy story. I must check the source on it. And I don't always analyze if something's even half amusing or a little bit, I'll retweet. I don't put my name. I can't research every single tweet. But that I was like, wow, let me just have a look at that. Mm-hmm. Is that really true? It looked like an Onion article. And then I thought, damn, they actually did that. And they're admitting to a bag of stones. No one checked until somebody called for the nickel. Wow. I mean, who's putting bags of stones in inventory warehouses or where it's supposed to store nickel? I mean, and you're going to tell me that's innocent? I'm sorry, I've got a bridge to sell you if you think that was innocent. And what's going down in COMEX in the back? I think there will be a lot to come. So I think metals people should start to feel they're patient as monks, and it's been long season since the highs pullback, and that's required quite a bit of patience. We hit highs on gold here, which was July 20. Going into mid-July 20, and we're now 23, first quarter. But now we're starting to threaten new highs on the gold. And if I can, to fully answer the question on the gold-silver ratio, Tom, I'll bring up that chart and tell you what I think is coming, because I think this is really good news, and people need a little bit of good news that have been patient. In terms of this one, we've highlighted a few times that we think that this is a macro, multi-period head and shoulder, and that you had, and this is why I said the events of March 2020 were so seminal, because they were the reversal of bond. So your first kickoff from this entire question that's taken us on this journey of response and chat was the banking crisis. What does it call for you? And Fiat system is borrowed into existence. So you're talking about fiat, you're talking about currencies, it's FX, and the liability that you borrow into existence, which is the bond market, the debt. And then the intermediaries that actually have the license to create that are the banks. So you're talking about the holy trinity of money creation and of fraud, in my opinion. So with the gold-silver ratio in this structure, Tom, we are essentially, after making those comments that I did about the holy trinity of banking, finance, debt, and currency, we're seeing a reversal structure here in gold-silver ratio of epic scale. I'm looking at it on the weekly chart. It could even fit into a fortnightly chart because I've got the candles quite bunched up. But it's our take technically, and that's what we do. Macro technical analysis is our game using the HVF method. It's our take here that we have what's called a complex head and shoulder. And you may recall I said March 2020 was a seminal event for the turning of bonds. It gets reflected also in the high quality assets such as gold and silver. What's bad for the debt system is good for the non-printable anti-fiat system, which is particularly gold. And the blow-off dump in the yields, which was a blow-off high in bonds because they have an inverse relationship, was also a blow-off high in the gold-silver ratio, which is typically bearish. So this was the blow-off high, and you can see it's associated with March 2020. You're right about there. And that neckline valuation, where I'm showing you had an interaction here back in 2016 July, you might remember that there was a bit of a Shanghai Accord that got put together when China's first hyper level of indebtedness, after creating all the heat post 08, 09 in the economy, they went on a borrowing and building binge and buying all the copper and knocking up buildings, half of which are being knocked back down again, and bank runs and apartments that haven't been provided. They went and did a 2008 of their own, only they did it in the void that we left in the post-apocalyptic 2008 GFC of our own. So they created some heat in the economy and managed to keep some things ticking on whilst they did something similar. And what we got was a dip there to the 65 on the neckline. And then we had this huge blow off that brought in the March 2020 events. And we haven't been that high since. And in fact, it's probably the harshest sell-off we've ever had in the gold-silver ratio. You went from around 128 down to 65 again. We refer to these as armpits, for want of a better phrase, 1 and 2. And these are huge structural things. This is July 16, right the way to 21 July. So you're talking about a 5-year head, not including the left shoulder and not including the right shoulder. So this has been brewing for a while, and it's the death of the debt system, because if this triggers, just to make target, you will be trading at 32 times the gold-silver ratio. And we haven't seen 32 in absolute ages for gold-silver ratio. And remember, head and shoulders, whilst it makes a target, which it can do, it's still just a probability that it in suggesting it could do. It also overperforms that. And we've gone so far as to do other analysis that I don't have easily to hand today, but that says you could actually dip below double digits gold-silver ratio, so that you could be a 9.99. So that's the supreme overperformance. But here you have a technical structure for 33, call it 33 as a target. And if you just look at where gold is today, let's just say 2000 for ease of use, a third of that, well, 33 and a third of 2000, if gold didn't move higher, which it, in my opinion, it absolutely is likely to do. Well, let's just say it goes to 2.5 as part of this process. You're going to have silver at for every one, you'll divide by 100 and multiply by 3. So if we had 2,500, you'd have $75 silver, because you divide by 100, multiply by 3, it'll be 33x. So you're going to be at $75 silver here. That's if gold only went to 2,500 as part of getting this entire collapse. So this right shoulder is a broadening structure, and that's typical of downside continuation in time. It's a big structure, and we expect reversals at the splitter when it can no longer make it to the other side, which is up top here. And it looks like we could be getting a little bit of a reversal, but we might churn around for a bit. It's not, people think are you giving me the exact second and day that this happens? You have to be big of mindset. It could grind a bit higher for a while, then get thrown down really hard. Then it will grind a bit for a while here. So it doesn't mean I'm talking about tomorrow. Mm-hmm. But then once the 65 level is run, all bets are off for at least a 33 run, and I would expect overperformance on that. And I have suggested in other content that we've done that the gold-silver ratio goes below 10. Mm-hmm. So that's beautiful for silver owners. And it's going to be very strong for gold too. You're not going to be unhappy with your gold performance. So that's what we await.
As we talk about, the idea of, let's say, getting down below double digits in that gold-silver ratio, thinking about timelines, as you just said, we're not pointing out the exact time that that's going to happen. But for a scenario like that, is it possible that that's, a spike up in silver, not unlike what we saw, let's say, in 1980, where it was only there for a day or two, really?
So the interesting part about that question is when you take us back to the 80s, people have associative thinking. They think, will it be like then? Mm-hmm. And nothing about where we are today is like then. The level of indebtedness is absolutely insane. So people want that association. We want to hold on to something already known. You have not lived this era ever in your life. And I don't think anyone in humanity has, because we actually have an entire globalized economy that is all sick with the same disease. Outside of Russia, even China's hyper over indebted. Even on the BRICS side, and you talk about Turkey, South Africa, India, these guys have many of the same issues. So you have never seen what's going to come. 80s is small fry to the scale of this. That was, post-Vietnam War, it was a very expensive conflict. The gold was still largely backed. At least for nation states, France started calling for their gold. That's the history around that. We're in a different era and time where there's going to be a complete loss of faith in all fiats, and they're going to problem, reaction, solution us into a CBDC. But in the meantime, whilst in the void of that central bank digital currency and skeptics and libertarians like us, it's very, very difficult not to see a spike on gold like how silver spiked in the 80s. And there's something on silver that you've probably never actually seen. You could actually be talking something bizarre. I don't want to be the guy who throws, the biggest number out, but you haven't seen that level. The Volcker era, I think America was in and around 35 to 55% debt. They are well through 100. And when you take funded liabilities that are all coming due now in terms of commitments to welfare, Medicaid on the boomer generation, as they all seek to be major drawers down of those services, they're unfunded. So the escalation in debt required just to meet existing commitments, they have to default at some point on the social contract at minimum. And you now talk about the incredible degree of inflation, the bifurcation and deglobalization. You have never seen all of these trends. All of them point to stubbornly higher prices. The problem we should be asking is, what kind of a world are we living in if the gold-silver ratio goes single digits? Because there is going to be, let's just say we're white Anglo-Saxon audience, Europeans. There's going to be poor whites begging at streets all over the place. You're going to see poverty inflicted on categories maybe that have never seen it. You're going to see crime. You're going to see 70s plus. That's the hyper-stagflation message. So security is going to become key. Security of wealth, security of tenor. I actually think it's going to be cool to be not flashy. Because it's going to be smart and wise and pertinent. So, the bling bling of gold painted Lamborghinis, that is going to look like a very curious kitsch relic of people, new money people. And you'll attract all the wrong kind of attention. So I see a lot of debunking, the wealth going rural, the wealth going independent, forming localized communities and restarting again. And it's going to not be about gold watches and, et cetera, et cetera. It's going to be about practical things. There's good quality solar panels, self-generation, self-reliance. And then states not wanting to lose their role and their dominance as intermediary of, utility service provider, putting in draconian communistic Bolshevik type laws to try punish people that become self-reliant. In other words, you can't be allowed to escape their system. They own the right to extract from you for basic services such as water and electricity, etc., etc. So this is the battle we're going to be fighting for: freedoms and independence and sound money. And then, as I say, the CBDCs are going to come in with biometrics, all sorts of social scoring. We've covered a lot of this resetty type stuff before. But you've got to make that investment, and you've got to accept that winning this trade is also winning, being the best and the wealthiest in a starkly contracting piece of pie, and others looking at you with envy and green eyes. So it's a difficult prize to win. It's not like, we're all winning together. The stock market's up, the property price is up, everybody's buoyant. It's an inversion of that. A lot of misery, a lot of people that are underprepared. So you're going to have to decamp and find a community of like-minded who have also taken this level of insurance against systemic failure.
So, Francis, I'd like to ask you how you think, let's say, we get being pushed into those CBDCs. This is something that I've had a lot of listeners bring up recently. So how do you think that we get to that place? How does that happen, let's say?
We did a video with a gentleman by the name of Clive Thompson. It was, in fact, he first chatted with Mario, another nice, good YouTuber guy, and I did a video about their discussion that spoke about how to properly rinse the debt out of the system that they've created. It has to be left to wither on the vine. It doesn't make it through into the new system. And that they then create a two-tier market. And then because of restrictions levied on the old money versus the new money, you start to be able to use it less. It's less attractive. It doesn't trade at par anymore. And it quickly starts to taper down and goes until it's tapered to next to zero. And then there'll be black market intermediaries that will be swapping your old money at a much more non-beneficial rate to get you into the new money system. And the way you just do that, you just turn it into second-class money, and you put restrictions on it and various other things. So that in this transition, you're going to have two trains, and you allow people to exist on both with a skywalk, but you slowly, the other train slowly starts going slower and limping behind until eventually it's blown off. And people that are stuck with wealth in the old money world will not. And I've referred to gold as the golden archway that takes you from the new train, the old train, into the new train. So you've got this old chukka train on rails, and you're being put onto this new monorail that is running alongside it. So there's a parallel running period where you wither on the vine on the old money system until eventually it's tapered away to a nothingness. So the first mover it'll be classic of trading. The first loss is your best loss. If you haven't got your old money system into something that will bridge into the new money, you will be in trouble. And the longer you leave it, the worse it will get. They'll first make a mock effort at maintaining like a peg. And then it will drift, and they'll say, well, you can only buy these things on this, and they'll make the new money more attractive initially. So a lot of the surveillance components and maybe even the social scoring, they might not immediately introduce. They'll make actually the new money relatively convenient, super fast on the Ripple network. So we've highlighted in our community all the status tokens that are likely to be winners, that are pro-government in its current form, working with status systems to bring it in. And those tokens could actually do very well, but they're not your friend. But they'll be introducing the CBDC. And then slowly they'll open all the Trojan doors once they've moved the bulk of the people from the old money into the new money. And I described it as a sort of 16-laner highway, which is tapered down to 8, 4, 3, 2, until you're just a single lane going through a boom, and only so much money is let through. So if you're a retail guy with $5,000, you might get to convert your $5,000 of old money to e-dollars, whatever the name may be. But the wealth, they actually want to destroy the middle classes, which will be many of your viewers watching right now. They want to destroy you and strip you away. They don't care about letting a few Joe Schmoes through on their, their own personal allowances of 5,000 here or there. They'll move them on, and they'll be willing. They may even give an incentive. They may even say, do it before this time, and we'll actually give you a bonus. They'll turn it into, look at us, how kind and good we are. Get it done by now. Turn your 5,000 old dollars, get 5,100 e-dollars. And then you can only purchase this or participate this in e-dollars. So you start creating privilege and demerit by elevating the one over the other. So there'll be a natural black market exchange rate between it for people wanting to get, and slowly it just extends where it becomes eventually very obvious, and it skids into a very low relative value and is left. And that's how their liabilities on things like pensions, and other things can be whittled away. You just diminish its value and you whittle it away. And then what do? Well, you say, well, your pension owned that debt. It's been whittled away to next to nothing. But we will compensate you providing you do the following things. And that's where UBI will replace pensions and various other things. So you'll get this compensation, but it will be in the new system. And that's how they will essentially drop this massive multi-generational buildup of toxic debt and just sever it and disown it like somebody flushing their own toilet. It's not of their creation, and they'll move on forward. So that's at the top level. We drilled a lot more down in those details, and I can drop you a link to that YouTube. And we actually got Clive Thompson on to discuss it on our channel as well. But it's a very interesting transition, and playing the transition correctly is going to be one of the most important things. But bullion holders have already done one very core important thing just by doing that alone. But don't forget, you might get a registry. You might have your banks asking you, where's the invoice that you bought this bullion with? Where's it kept? Where's it stored? So they'll initially ask for information where you are encouraged to declare it with no sign of taxation or costs or anything. But you'll be obliged, and you'll be told it's illegal not to inform and put various social pressures. We're just gathering information for, the American system and its sisters, its citizens. How much is there within the borders? It's more like just nothing more than just, a census poll to understand the numbers of population, for example. Meanwhile, once you disclose and anything the banks say, and we've received information from your bank that you recently invested with one of these companies, which we understand to be bullion. So you've got to understand there will also be attack vectors. They don't want a middle class to survive. They're looking, if you understand the end goal, they want utter reliance on state through all citizenry. You're either part of that system at a managing control structure level, or you are utterly reliant on them. And you get what they decide you are worthy. So that's where they start to have complete control over you. And metals, which is liberating, they're going to want to have it off you, or they're going to want to tax you and make it expensive to hold. So I would never tell people to not comply with the law, but I would say watch out for some pretty foxy laws to come in terms of that. So just by doing the one thing and ensuring you're in metals, that's part of your solution. It's not your only game to play. These guys truly are psychopathic, motivated, and relentless about their end objective. And for me, that is complete reliance on state for everybody. And the middle classes are the enemy. They actually weaponize the poorer classes against the middle, create culture of envy, do lots of clever chicanery. And, just Elizabeth Warren as an example of, the attack on billionaires. You'll soon be all treated as if you're billionaires, even if you've just retained some buying power and you have a few $1 million in precious metals after a major run. You might only be worth a few $100,000 today, but those dollars will be diminished dollars, but now you're a millionaire, And what about the poor? And, you have white privilege, or you have some kind of privilege, various other things, and time for reparations. And, there's lots of attack vectors in cultural wars that they've also already pre-primed to do this. So, you had the benefit of better education, that you're able to do these things and all of this. So that's what you have to delve into to think. It's the beginning of the game. your investment in precious metals. It's not the end game. And many people are a bit lazy. They think, I've done it. I get it. The money's stale. I bought the gold. I've done my job. Well, where is it? Is it vaulted? Do you own it physically? I've had banks requisition. I've actually had a bank that says we don't allow anyone to invest in cryptocurrency or precious metals. After they demanded an invoice for a 6-digit investment I made, and they said, we see this as in precious metals, and that's the breach of our rules. So you've actually got a banking system in certain places that is actually saying sound money, the pursuit of sound money is an attack vector against them. Well, therefore, they are unsound money. It's almost like an admission of guilt for me, but that is what's going on. And I think more and more, you are the enemy, and they're going to go, oh, we've got these pet rock lovers, and they've created a shortage in silver, and we're trying to save the world from the climate crisis, and we've got all these pet rock lovers that are stacking this stuff and causing a short supply, and now we need to build Teslas and this and that, and there's shortage of silver, and they've pumped the price, and now they're financially getting a gain. They're going to position us as Hunt brothers, the bad guys who cornered the market and brought this. We're all a collective Hunt brothers now. We've created a shortage by stacking. That could be a narrative as well that plays out. So there's a lot of ways you're going to be made deeply unpopular. And I would say discretion is the key here. Don't be a braggart. People like me have problems because we're public figures and we talk our game and we try to be as truthful as possible. Well, you might need some invoices for stuff that you've sold. Let's put it that way. And be sure to sell some when it makes highs, get some land and build it. But yeah, I think we're in totalitarian times, and it's a sad fact that this massive trade, which should be one of the most joyous moments for you, will probably come associated with deep, deep social unrest and your country no longer feeling what it once was. You go through decades with nothing happening, and that's this debt buildup has been like that, occasional forays, and then suddenly you're going to have decades happening in days, weeks, and months. And I fear for us that this contagion just rolls through.
Francis, we were talking about the idea that gold is a golden transition bridge. You use that analogy. Is Bitcoin part of that as well to you? Like, is Bitcoin going to be a good form of, or let's say an alternative currency to be able to protect some of your wealth in? Or how do you see the role of Bitcoin alongside gold?
I'm a slightly more circumspect with Bitcoin. I think it can potentially be. The difference is it's digital, it's deeply surveilled, it's easy to spot who sent what where. So digitization is the empowerment of state over you in all things. So, cloud, which they've all pushed us on, this was the trend. You've got to get into cloud. This just means a state-based server instead of your own computer drive, essentially. Hey, you can have it wherever you like, wherever you have internet. You're putting it in Amazon, you're putting it in Microsoft Cloud. That is a statist organization that bows to states, bows to surveillance, bows to everything else, and scans your emails, scans your drive, scans what you're looking at. And when you have an overreaching totalitarian state that has brought about the events of March 2020 with quite dark agenda, if you haven't had any second thoughts about that, then you might think I'm a theorist of conspiracy nature. But when you recognize that not everything the top level of state does is in your best interest, anything pertaining to surveillance over you is a problem. That said, for now, we're seeing it behave like that. I personally don't assess that there was any, kind benefactor. I've always asserted it's a Santa Claus story for adults, the Satoshi Nakamoto narrative. On balance of probabilities, do I truly know? No. Were there some people that were collaborating? Yes. Did they probably have some very high connections to the three-letter agencies? I would imagine they would. And I think that was part and part. Bitcoin, on the one hand, Bitcoin is early trading, beginning trading, trainer wheels on your bicycle for the implementation of CBDCs. There'll now be enough people in different families to show granny how to do a wallet send from one wallet to another. That's we are the advanced party of education to other family members on how to use potential future CBDCs. It will be very similar to everything we've done so far in cryptos. So I prefer gold. I think you should be more in gold. It's also more stable, less beta. But I think for your spice and your speculation, you should have a component of it. But when they launch a CBDC, my big question is, they either must own the majority of Bitcoin themselves, in which case it survives, or if they don't, and the Nakamoto wallet isn't BlackRock on behalf of the big families owned and held, then you are essentially participating. If it was truly free, you'd be participating in something that is a better asset class than the CBDC. And their standard doctrine is competition is sin. Mm-hmm. They will not let you have your own money. They will not let you have your own money. So it's either controlled and they are the dominant holder. That way it survives. So it's bad news, but it survives. In which case, any upside you gain from, but they are gaining even more, and they watch you and tax you and make you register, all those things I was referring to on precious metals. Or it is genuinely legitimate competition to CBDCs and eventually gets outlawed. You have to register it, and it gets tapered, much like I was tapering the old debt. They make it very hard to use. They punish it with taxation, all sorts of rules. You've got to register every single one to make sure you're not buying AK-47s on the dark web, in the name of keeping the people safe, etc., etc. So either ways, there's problems for Bitcoin in whatever manner it goes forward. It's either fully captured, in which case it could indeed survive, and they will hold a lot of it, but they will want to extract and tax you and register it. So you're going to just get complete surveillance and complete transparency and lots of extraction. So that whole notion of, free, libertarian money will die, but it can go up in value, versus they don't fully control it, which I'd be surprised. But when CBDs come, it just served its purpose. It's kind of like Apollo, whatever rockets, it has that base fuel that just gets you out of the gravitational pull. And then once you higher up, you just drop it. And it served its purpose for getting you that high. And then you're on the smaller tanks that take you up further. So it just played its role for a stage, and then it gets retired. So there are some Bitcoin believers that won't like that message and that possibility existing. But every time I game theory this, I think they either absolutely control it and have the bulk of the tokens by now, including the Origin wallet, or they will seek to marginalize it in some way. So both of those things are concerns. However, short-term trading and investing, I see it going up, and I'm long it and a holder right now. But that's not forever. I have targets. I'll take off, and I'll regularly stack some of those gains into silver and gold.
Interesting. Francis, the only other thing I wanted to touch on with you is, you think about things at a very macro level, but you're also a technical analyst. So if we could run us through, let's say, some of the limitations of technical analysis, and maybe we can use, let's say, the oil trade as an example of that. We're seeing oil and energy get just smashed right now. And a lot of the narrative that I've seen around energy is that, we need it. We obviously do need it, but that it was going higher. And then we see it just getting absolutely hammered right now. So how do we look at that in this broader, let's say, macro context of the period that we're entering?
It's an excellent question. And you brought me to the key message, I'd probably say, of the video that I would love to get out to everybody watching. This banking problem that you asked with your very first question, is not over. There's a lot of people that are by the dip. All the central banks stood up and were there representing you and have saved the day, etc., etc. This is contagion likely. You're going to get a period of pause and everything's going to feel fine. I want to remind everybody that 2006 was the yield curve inversion for the subprime crisis. And if we had more time, I'll spare you this time, but I actually did a deep dive recently on the yield curve inversion. And 2006, you went under. It's when you break back up out of the yield curve inversion that the crisis came. And that was late 07 into 08. And all that time you were in negative yield. And it is the 100% advance messaging service for major downside. And let me also say that the current yield curve invention went much lower than any of the previous modern day crises. You literally have to go back to the 80s. Much faster, much lower. So instead of being a rounding, dipping through and a little bit of basing out, it was a plummet through the zero level and actually went to about minus 1.28% on the Fed's favored measure, the 2s and 10s, the short and the long. Mm-hmm. And what tends to happen technically when you do that is the faster in is the faster back out. So it's more volatile in and out. It's not rounded basing price behavior. And it's gone lower. So the deeper you drop, the more extreme the likelihood generally of the next crisis. So this is going to be a mother of all crises, I'm afraid. So that's a little bit black pill for everybody, and it will reverse violently. Now, the banking issues that happened recently, that was part of your first question, saw the short term, the ones and twos, and I can show this on charts just briefly so that everyone just sees what I'm referring to here, saw the short terms move much more violently than the long term. And that's brought about a sudden and stark reversal in the yield curve inversion. It's still negative, but it's quite violent and quite sudden and quite stark. So I'll show you, say, your 1 year and your 2 year. And people need to watch bond markets. Generally, guys aren't focused on bond markets. We don't understand it. It's not typically an investment a retail trader makes. But if I drop down into this daily, that is what we would certainly say is a slap in the face. And I'm going to de-log that. You can see that. That is a very abrupt correction in the short term. You were walking up, low vol, nice little channel, and then smack. Now you are going to get some kind of reaction and rally. But that is typical of trend-changing events. You get a blow-off. The bond market went something like that up high and then got slammed really hard in March 2020. And you saw the gold-silver ratio, which was the chart before that I showed, where you got a melt up and then you got slammed very hard. So these slap-in-the-face technical events are typical of potential turning structure coming next. So you either get some form of reversal structure. You might get a head and shoulder. You might get a rally here, and then you get another down leg, and then you get a rally, but not as high, another down leg, and then you get something like that. And the next thing that happens is that. So I don't believe rates will go to the lows that we had in March 2020. I stand by the bond market having turned, and yields will never go that low again, but you could get quite a uncomfortable correction back down to 2, for example, or 2.5, and that's going to be associated. The problem they have now is that inflation is stubbornly high in spite of the consumer being wrecked. So it's no longer about the consumer. We have two economies here. The consumer is already crushed. We are in a recession. When we met the criteria for a recession, we were in a recession. They just decided, no, we don't believe it this time. The labor market is red hot. That's just making up the rules as you go along for your game. We are in a recession and the consumer is wrecked. You've got 6 months of downside housing prices. There's plenty of evidence. And the labor market is not so hot because they're using a measure that has the birth death model. Other polling studies have shown a complete divergence with the non-farm payrolls numbers. And they are clinging to a fake number to say you can't be in a recession as long as you've got so many jobs being created. But you've never had lower workforce participation. You are at peak retirement age for boomers as of December last year. So people are standing down. All of these things. And actually, the inflation, the growth in salaries is quite low. So people are not earning. They're working multiple jobs and crappier jobs. And this is what's happening. So with a correction like this, which won't go right down to the previous lows, but will be something, you'll be having a demand destroying event, quite likely. So yield curve inversion is a big, big thing. And you asked about energies. Energies is a great measure of activity. I've often referred to it as the Rockefeller tax. When we were having peak housing prices in 2006, you had oil hit $150 almost in Brent and around 140s in WTI. And that was how they were skimming all this mass affluence fluff that we were all feeling rich. We had a ATM attached to our house. You just had to release more equity and go buy a new car. It was easy does asset inflation and keep adding the debt. Low interest rates, and the oil price ran up. And that's how it's kind of like a skimming tax, your oil price. If I take you to oil now, it's set up to crash. And I want to highlight, you asked about oil, but natural gas before that first crashed, we saw that and we called that. And there's a uranium, and uranium had a great run and is now set up to go down and sell off as well. So it's not just oil, it's the energy complex across the board is going down. That means less factories making stuff, less demand. So let's take you to the USD WTI.
I was just to interject there for a second, Francis. That's, associated with this period of slowing growth and slowing demand that we're kind of facing, right?
Correct. In other words, reduced activity is reduced demand for oil, without a doubt. Reduced economic activity and oil goes down. Don't forget, we're in a low tempo war in Russia, Ukraine, which should normally be between two major nations for which NATO is a proxy participant in as well. This is what you are having. And what I'm actually seeing is the narrative goes like this. This is actually just a holding war. I mean, this is not B-29 bombers just blanket bombing Kiev and everything like this. This is a kind of a holding war. And God forbid, lots of people are dying and it's a tragedy and all of that. I'm not belittling it. But it doesn't have that full scale element to it that it could be. There's no nuclear. There's very little at an Air Force level. I think we had a SU MiG dump some fuel on a US drone that was thing, but we actually aren't getting much air related. There's bombing from air. It's kind of an artillery and infantry game with a bit of trench warfare. But in spite of that, oil should still be very, very strong. And in fact, it was in the anticipation of this war that we got this massive head, which failed to make this higher high here and then spilled all the way down. And what is the chart I'm showing you? It's WTI, but instead of the dollar, unfortunately, the dollar's become part of the story. I put it up against Western Texas Intermediate, against the Dixie, my apologies, which has got the euro, the pound, the yen, and a basket of other currencies. It's a better reflection of fiat. Mm-hmm. And what you actually get is a very clear-cut squeeze break. We were calling short here. And you have triggered an inverted head, my apologies, a head and shoulders, not an inverted head and shoulders. The value here when we were short is, so the Dixie's around 105, 106, we'll check it now. So it's essentially almost dividing by 100. So oil was around 70, 75 here when you're at 0.7 here. So you're dividing by 100, so 70 becomes 0.7. But this target's down to 0.38. That points to a dollar oil price in the 30s, unless the dollar goes really down a lot. In other words, and the euro and the pound and the yen are really highly valued, then you might be at the low 40s. But if the dollar is actually dominant, and then you could even be in the low 30s. So just meeting this head and shoulder target, left shoulder, head, right shoulder, you're going quite a long way down. I normally put this chart in log scale so that you can appreciate it more easily, but that's how it looks in log scale. So you're broken. You're getting a little bit of a bid rally, but you have surrendered this key level of support, which has essentially held up that entire broadening structure as a left shoulder, this entire head down to here again. And then you have what we call an inverted HVF with a downside target of 0.59. And that is already meaning you triggered the head and shoulders. So the actual bigger move is into $30 oil. And that was from 75 that we called it. It was 75. Now you're looking at the oil that's $68 WTI, and you're at 0.67 on the Dixie. So that's about right, as you can see. So actually, you're in a war, yet the dollar has gone down. My apologies, the oil has gone down now, has just broken down. It was the expectation of the war that it went up in the original case. And actually, the nature of the war, it's probably not escalated as much as people expected yet. And as a result, it's going down. And clearly, the consumer as I've said, there's two economies. The consumer is not doing enough buying, there's not enough packaging, there's not enough spending on Amazon and buying goods and having it delivered and, you know, flying on travel and driving around the country. That is not filling the gap. So the consumer is wrecked. And the people who are buying are the military industrial complex, having emptied all their arms and ammunitions to Ukraine. They are upgrading to modern generation. And we're seeing the military industrial complex shares going up, while oil shares are actually going back down again now and are running into trouble. And I want to highlight that this didn't start with oil. It started with natural gas. So if I go here, we were supposed to have the lights out in Europe on account of, you know, all the problems with energy, not buying Russian gas, all of the sanctions and drama that they were talking about and they had created there. And natural gas, just so that people can see, these head and shoulders do perform. This was a head and shoulder we drew on natural gas. There it is. It was as high as 10 up top there. And we said it's going to trade sub 3. And it's gone and done that. It triggered at 5.4 and it's well sub 3. There's your target of 2.9. And now you're bouncing around after making a low. So gas started to fail. It broke the end of 22 to the downside. They weren't going to have the winter. And of course, they were buying a lot of coal from South Africa. That went up 700%. And in exchange for buying gas from Russia. And coal is the dirtiest energy. So, and that was Germany. So, you know, so much. Germany is the big green. But when it push came to shove, they were buying 700% more high-grade coal from South Africa. And just to avoid buying gas from, which is cleaner than from Russia. So this is the game they're playing. And gas has crashed. Gas has crashed quite substantially with that deficit of demand, and it was the first to go. It triggered in the beginning of the year. Now you're seeing oil, and I'm seeing the same on uranium. So this tells me there isn't expectation of a large amount of energy consumption going around. This is the early doors setup again for uranium. Again, we're seeing this as left shoulder, head, and now you're getting your right shoulder here against a neckline here. So this is early doors break. You could have got in short there. Yes, it's getting a little rally there, but I think it comes through that neckline and goes. You can see roughly there it was. That's a global X uranium ETF. And most of the uranium charts have similar structure. I don't need to go through each one of them. So all of those are showing that they like oil getting ready to roll it over. So what's happening? Are we going to have lockdowns on a basis of climate? Are we going to, or is it just going to be a depression on a basis of economic contraction? I can't tell you. We get the answer later. We trade the technical, the news comes later. Don't trade the news, it's too late. So we're short the energies complex, and actually the military industrial complex is at near highs. And we've got European military industrial complex shares that we're expecting to go phenomenally higher. So they are emptying out the larder and they are restocking. So that means they're preparing either for a new war that will come, and that will then lead again to oil going up, because a proper war is generally good for oil. But I don't think the Ukraine war has gone into the scale yet that it's meaningful to countervail the crashed consumer. So what's actually happening is government is crowding out private expenditure. You have crushed consumers that are not providing sufficient demand on the energy markets, especially as the Northern Hemisphere pivots into summer. And you've got a war going on that is government-led by two governments, or three or four, NATO's many, and it's not sufficient to countervail that. That should tell you how bad it is for the consumer. And the bond market that I referred to on the short term is the reversal of and the beginning of the journey back up out of the yield curve reversal. And as I mentioned, it's actually that when you come back up out of yield curve inversions that you have the crisis. The yield curve inversion, the initial instance, is actually the warning of a forthcoming crisis coming. It happens as you get back out. So if I just get your 10-year on the bond up again, and I take away from it, let's say the 2-year US 02. So we're getting the difference in the yields between long-term and short-term. And I've got this chart that is kind of done very much for this discussion. The red boxes, I show you when the crises occur. So let's go monthly and pull this through. So I'll move that down there. You can see the early 90s slump. That was in the early 90s. You broke down in the orange box area around about 1st December 88. That was after you'd had a year of recovery on the 87 crash. But the crises of 1991, that got George Bush Sr. thrown out after one term. He said, read my lips, no tax increases. Then he wanted a tax increase, and Clinton got in. So the red boxes are your crisis event. The Asian crisis of 97, you first came close to inverting and then inverting. The red boxes is when it happened. The dot-com recession, you inverted January of 00, but you were actually 2001 and 2 was your recession. The subprime, you inverted here, 1st of December 05. So it was even before 06. But the crisis actually came 708 into the red here. So this is a brilliant leading indicator. So if I let go of all that history, you'll see that the depth that we've inverted to here, right down there, is far, far lower. So what's it going to be that's going to destroy this demand? And this was quite a big candle. It's a little bit coming back now, but it was quite a big candle. You were minus 1.09 on the 10s and 2s. And in one month candle, you went to 0.33. So you gave up 60 or 70% of that inversion. It's having a bit of a pullback now. It's about 0.588. But you came super fast in here, and we expect super fast out. So there's a crisis that you'll learn the name of in that red box. And I fear you don't get ever to go as high again here, because I don't think rates ever go that low. So this will go like this, and we'll go straight into another crisis. So you're getting reducing bond long-short differentials. You're getting less higher highs here on each crisis, and you're going to dip lower in each crisis, assuming we don't get the full-blown reset in that red box. You'll probably go into another very shortly. So yields are telling us we're waiting for this to come back above zero. And then you're about ready to find out what it is that's broken. And debt, banks, derivatives, repos, all of those things are possible, but also they will associate a social thing, maybe a climate change response, to go with it. Much like you got March 2020 events associated with a repo bailout of September, October 2019. So there's one for you, the masses, to get a fixate, to get distracted by, and then there's the real reason in terms of the financial plumbing. And that's pretty much how I see the game playing out.
Excellent, Francis. Well, I really appreciate you, really tying all of these big picture things together for us. It's very valuable to be able to look at this bigger picture, to understand and hopefully help people see where all of these different pieces of the puzzle fit together.
Yeah, thank you, Tom. It's very easy for people to get attracted by certain narratives. I need to see what it's saying in the charts. Oil, natural gas, and uranium are telling me economic hard times through the consumer. That is so big that it's countervailing a hot war of quite some scale. That tells me pressure on the consumer. They're not nearly as in good shape. That means housing continues downside. Rates are high. Banks' willingness to lend on cars, we didn't mention subprime cars, and property is greatly reduced. The likelihood and the risks to return and payments are greatly reduced. So you're also seeing a reduction of financing. That same goes for commercial property. 70% of listed companies need to roll debt. Many of them were borrowing money to pay dividends. This is just hyper leverage of everything. So most asset categories can go down unless you are in the sound money ones, such as the ones we've mentioned, and one or two others. We focus on what's the truth by looking at the technicals and trying to calculate the true narratives and being prepared to short markets with real stops, real entry points. That's what we do at the Market Sniper. If you want to build wealth during reset periods, maybe give us a visit and book a call. It costs nothing and there's absolutely no commitment. And thanks for having me on, Tom.
Anytime, Francis. I really appreciate your time and sharing these thoughts and ideas with our listeners. And of course, you're available on Twitter at the Market Sniper, and as well your website, themarketsniper.com, right?
And YouTube for those that just want to watch a little bit and get to know us a bit better as well, under the Market Sniper and the Crypto Sniper.
Right. Francis, thanks so much for your time today.
Absolute pleasure. Thanks for having me on, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.